Okay, ladies and gentlemen, as chair, I would like to welcome you to the 7th annual general meeting of the company. I can confirm that a quorum is present and that we can proceed with the business of the meeting. I would like to introduce my fellow directors, Margaret Stevens. Say hello, Margaret. Andrew Rose and Tom Yoritaka. Shortly, our investment manager will present, Joe, will present an overview of the portfolio, markets and the outlook for the year ahead. I hope shareholders will find this presentation insightful. There will also be an opportunity for questions. We will now turn to the formal business of the AGM. The notice convening the meeting has been in your hands for the requisite period, and therefore, unless there are any objections, I would like to take that as read. Thank you. As set out in the notice of this annual general meeting, 15 resolutions will be proposed. Resolutions 1 to 10 will be proposed as ordinary resolutions requiring a simple majority of the votes cast to be in favour to be passed. Resolutions 11 to 15 will be proposed as special resolutions requiring at least 75% of votes cast in favour. To more accurately reflect the views of shareholders, I'm requesting that voting today will be conducted by way of a poll. Equity, the company's registrar, will act as scrutineers. Since we are conducting a poll, the resolutions will not be read out individually. Our investment manager will now provide his update, after which we will give the opportunity to ask questions before the formal business of putting the resolutions to the meeting will be done. Okay, Joe.
Thank you very much. Good morning, everybody. Thank you for joining. In particular, thank you to the shareholders who are here physically in person and also to the shareholders online. So as you've heard from the chairman, my intention over the next few minutes is to review the last year, to tell you how the portfolio is positioned, how we performed, and how we see the opportunity set for the trust in the coming year. So just as a reminder to set the scene, AVI Japan Opportunity Trust is today a fund with total assets of well over £400 million. And as you'll be aware, our strategy is very active in the sense that our portfolio differs greatly from that of the benchmark with an active share of 99%. And it's a very focused portfolio, very concentrated portfolio with somewhere between 15 and 25 total holdings, and the top 10 making up a very substantial proportion of the NAV. As at the year end, we traded at a discount of around 5%. That's pretty wide for us today. And more commonly, we trade much closer to NAV today on a discount of around 1–1.5%. And in fact, in recent weeks and months, we have been trading at a small premium and have been issuing shares. We make use of gearing. Today, the gearing is around about 8 or 9%, and we still have capacity to add to that. A key feature of the trust is the fact that we've got rigorous discount control mechanisms, including an annual redemption opportunity set, as well as an active share buyback should the discount widen. And another driver behind that is the commitment of the manager to reinvest 25% of the management fee into shares of AJOT, which means that as of today, AVI and individual members, individual staff of AVI own well over £4 million worth of shares. And that's set to continue to grow. Our long-term performance track record is good, well ahead of the MSCI Japan Small Cap Index. But as you can see here, in the past year or so, our performance has been behind that of the index, and we'll talk a little bit about that as we go through the presentation. A key highlight of the past 12 months was the merger between AJOT and FJV, which saw Fidelity Japan roll into AVI Japan Opportunity Trust. As a result of that, that led to an expansion of our asset base, almost 40 to 50% growth as a result of that. And that led to a modification in the fee arrangements, whereby we were previously at 1% flat fee, and that's been tiered now to 95 basis points or 90 basis points above certain thresholds. But key, as I said, the discount control mechanisms remain very much in place under the new arrangements. More important and more relevant to us, and I think of greater interest, is that as a result of the enlarged asset base, it has given us more firepower to invest in existing portfolio names. So that is important. A key part of our strategy is to engage proactively, typically constructively, and occasionally more aggressively with the companies that we invest in. And owning more of those companies leads to a greater chance of success and leads to better outcomes. So the fact that we've been able to put more capital to work in some of our existing names, as well as some new names as well, has resulted in an increase in the weighted average proportion of the companies, the portfolio company shares that we own, and has meant that there are 4 or 5 companies where we own somewhere between 20 and 40% of the shares of that company, putting us firmly in the driving seat in our discussions and negotiations with the company. So I think it's a very, very positive consequence or result of the merger, and one of the key attractions to us of growing the asset base. So turning now to the performance over the last year, as I said, a healthy absolute return of mid-teen growth in sterling terms, somewhat behind the large cap topics index and also behind our small cap index. There are several factors behind that. Some of that is the constituents of the benchmark index. So the MSCI Japan, the strong growth has come, as you'd expect, largely from tech and AI-related companies, some defense companies and commodity-related companies. On a more portfolio granular basis, we had some pretty strong contributors among some of our larger holdings and 1 or 2 detractors that took away from the performance. But when we look at the portfolio and we review the performance of our companies, we're conscious of the fact that the portfolio is very idiosyncratic and the drivers of performance will be idiosyncratic. And in our engagement with companies, we're confident that we're making inroads. We've had some public campaigns. We're likely to have more in the future. We've got AGM season coming up and we'll be submitting resolutions to some of those companies. And the feedback and the response we get from the companies is positive. And not only that, but our discussions with other investors are also highly encouraging. And when we talk to other investors, there are a couple of different types of investors that are relevant to the thesis. Number one, we talk to other investors on the registers of those companies, and oftentimes they will be other foreign investors, foreign activist type of investors, or indeed domestic activist investors. We never act in concert with other investors, but we do have general discussions, and you can assume that we want similar outcomes. So even in situations where we might own 20 or 30 or 40% of a company, oftentimes there'll be 1 or 2 or 3 other like-minded investors, so taking the aggregate proportion of the shares held by like-minded investors to very substantial levels. The performance pattern that I referred to for 2025 for the full year has continued as we start this year. And I would just remind investors that our returns are lumpy. Our portfolio is very differentiated from that of the benchmark, and that when we do get catalysts such as takeovers or privatizations, they generally lead to quite a big premium in terms of share price performance, and that can provide a very strong boost to our performance, but it is lumpy. Another feature that comes up in our conversations with investors when they think about Japan and they think about the portfolio is the weakness of the yen, which is now extended for quite a few years. It has baffled many commentators, and indeed many investors and commentators and analysts have called for a strengthening of the yen for quite a while now. In fact, the economic conditions for that are firmly in place, in the sense that there is now inflation in Japan, quite strong inflation, certainly when wages, and the fact that politically inflation and particularly the impact on input prices, raw materials, is deeply unpopular. And notwithstanding that, the yen does continue to weaken, although in the last week or so there are signs of intervention and signs of commitment from the Bank of Japan to normalize interest rates, which should, without making any predictions here, should lead ultimately to a strengthening of the yen and a tailwind in terms of our sterling-based returns. This is just to highlight here the point that the constituents of the index, the MSCI Japan small cap, are very differentiated from that of the portfolio, and therefore you can expect our performance, certainly in the short term, to differ and to vary from that of the benchmark. And as I said, those returns can be lumpy as and when we see some corporate events and some catalysts. We get asked quite often, what is the opportunity set today? Have we missed the boat? Since the fund was launched in 2018, it has generated strong absolute returns. It has gone up. The market is less cheap than it was back then. And corporate governance reform has played out now for quite a few years. We were early to the game back in 2018, but now a lot of investors are talking about it. Even less activist and more mainstream investors are talking about it. What I think is very important is the continuing commitment of the regulators, of the government, of the stock exchange to regulatory reform, and to continue to make improvements and to put pressure on companies and on investors to do more and more and more. It's taken 10 years and we've come a long way on the journey, but there's still plenty to go for. And Japanese companies, when you look at their balance sheets and you look at the operating performance, on the surface, they may not look as cheap as they were, but fundamentally, there's a lot more they can do to boost margins, to boost returns on equity, and to boost shareholder returns. And to that end, the ongoing commitment from the regulators and the stock exchange, and indeed the political party, the political powers, is very, very important and should provide an ongoing commitment to corporate governance reform and boosting of shareholder returns. The success in the victory of Takeichi-san in the elections recently provides, I think, a further endorsement of the attractions of investing in Japan. She is firmly focused on boosting corporate profitability. It's a key part. She wants to do more. She wants to fire up the economy, and that again provides another tailwind and another endorsement of the story to invest in Japan. As I said, a lot of our work focuses on not only just finding cheap companies and hoping for the best. It involves in quite an active and intense process of engaging with those companies. And we engage on a variety of different features of those businesses. Typically, you'll find that we do engage on balance sheet factors, capital efficiencies, such as too much cash or having securities on the balance sheet or idle real estate, for example. We also focus on corporate governance. Companies shouldn't have poison pills. They should have independent directors. They should remove all the impediments to being free to boost shareholder returns. And we also engage on some matters such as improving investor relations, communication, publicity, making sure that more and more investors understand the story, and also on operational and strategic aspects. Those I think, the operational and strategic aspects are the key USP of AVI's approach. Sitting here with me today are two of our analysts on the team, Kaz and Yuiko. And if there are any questions on individual companies, I'm going to pass on to them. But you'll see here on this slide a variety of different engagement outcomes that really speak to the various different approaches that we take to engaging with companies. And we've seen not only us pressurizing companies on those things, we've seen outcomes as well, commitments to buybacks, commitments to closing down some businesses, to investing in other areas, and generally adopting a lot of the So here is our top 10 as it stood at the end of March. As I said, it's a very concentrated portfolio. The top 10 now makes up 70%. It's been a little bit higher in the past, as much as 80% from time to time. But behind this is really a commitment by us to run a concentrated, high conviction portfolio, reflecting our confidence in the ideas and our confidence in the progress that we're making engaging with companies. And as I said, just to highlight in the third column from the right, AVI's percentage ownership is important and interesting. You see here 3 companies with very substantial ownership of around 30% plus. And as you go down the portfolio, there are a similar number with similar stakes. But when we own more than 5% of a company, that gets disclosed publicly and makes other investors aware that AVI is on the register, and that can be very, very helpful in getting support from other investors as well as negotiating with other companies. This slide here reflects some of our recent portfolio activity. It reflects how we have invested some of the proceeds that we received from the Fidelity rollover, but it also goes to highlight two other relevant factors here, relevant to the question of have we missed the boat. The first is that when you look at the valuation multiples of some of the recent additions, you see some quite substantial NFVs, by which we mean net financial value or cash and securities as a proportion of market cap, and consequently low EV/EBIT multiples. So we're still able to find very inefficient balance sheet companies with very, very low multiples. And we're not running out of ideas. And we hope at some point in the next few months to benefit from a corporate event, which will see a large part of our capital come back to us. We're always running a reserve bench of ideas so that we're always confident that we get any capital return to us invested in similar quality names. Some of these on the reserve bench will find their way in the portfolio. Inevitably, some won't. And that really reflects the fact that we don't want to own everything. We can't own everything. We want to own our best ideas, and certainly don't want to give up on ideas where we think we're doing well in our engagement with companies just to make room for something that appears to be shiny and new, but we obviously don't know as well. This is a team that has grown substantially from when we launched 8 years ago with myself and one analyst. We're now a well-resourced team. I'd highlight a number of Japanese nationals on the team, which is important in terms of our engagement and dialogue with companies. So individuals who have got experience working in Japan, understanding Japanese culture, business, and obviously language. That process is a continuing, ongoing process. Our latest analyst, Yuriko, joined us a couple of months ago, and that AVI has a commitment to furthering that depth of the team. So just to highlight before and to conclude before we open it up for questions, since AVI's launch in 2018, we have delivered strong absolute and relative performance for our shareholders, surpassing the benchmark's performance by 3.5% annualized. It's a process that I think has proven itself time and time again. We invest in cheap companies, we invest in good quality businesses that are growing over time, and we engage with those businesses to make improvements, to drive shareholder returns. And along the way, we benefit from corporate events such as takeovers and management buyouts that really drive strong but lumpy returns. The opportunity set remains highly compelling, both on a micro level in terms of finding cheap companies, but also on a macro level with the tailwinds of ongoing commitments to regulatory reform and political support. And more and more investors are coming around to the idea that in order to drive returns in Japan, you need to engage. You need to engage in a way that is constructive and respectful and not bullying and aggressive. And we're all supported by the fact that there's a huge pool of capital in private equity funds looking to take advantage of these situations alongside us, which provides a further tailwind to the opportunity set. So that's all from my presentation. Thank you very much.